In this section, we're going to go through a trade example with the S&P from entry to exit and demonstrate in every detail each step of the trade management plan, just as you learned in the book material. We're going to look at the S&P and see if we have a setup for either a swing or a position trade. Swing trade being a trade that should last at least a few days. Position trade from a few days to maybe even a couple, 3 weeks. So let's take a look at the daily data, which will be our higher time frame data. And as of the last bar on the chart, we can see that the daily momentum is overbought. Now, in our dual time frame momentum strategies, if the daily higher time frame momentum is either overbought or bearish, we only consider short trades. And as you know from the book, if the momentum's overbought, that usually means that the upside is limited, and we are probably very close to a bearish reversal or a top in momentum and in price. So momentum of the higher time frame indicates we'd be looking or considering a short trade. The pattern is, notice I've labeled that first decline off the February 1st high as a 1 or an A. So it could be the first section of a trend sort of pattern, a bear pattern, or it could be an A section of a possible ABC coming down. And we don't know which it is, and it really doesn't make any difference at this point. The most important thing is that if it's a 1 or A, following a correction up, we should have another decline that would probably take out the 1 or the A low. And then I've labeled a possible ABC coming up from that 1 or A low. Now, I don't know if it's an ABC or not, but we've at least met the minimum conditions for a possible ABC in a correction. We have one section up, a section down, and then we have the third section up that's taken out the high of the first section. So we have the minimum, at least the minimum pattern structure for a possible ABC rally. We can see that it's reached a bit above the 78.6% retracement, and as you learned in the book, around the 78.6% retracement is usually the maximum retracement for a correction. So if the S&P is making a corrective rally up from what we've labeled the 1 or A low, it should be near the maximum in price. And notice how I said, if it's making a correction, I don't know if it is or it isn't. I'm just looking for specific conditions in momentum and price and pattern and time. And then I've also put on here the 100% high-to-high cycle. We can see the 100% high-to-high cycle was 1 bar before the last bar on the chart. So that's just some kind of simple timing that would alert us that if this market is making a correction, it's in a time position also for a high. So we've got momentum overbought, upside should be limited. We'd be looking for short trades. We have a possible ABC rally. We're at the 78.6% retracement, usually the maximum for a correction, and just 1 bar off of the 100. So this is the 60-minute data, and I'm showing data through the end of February 27th, which was the last bar in the daily chart that we just looked at. And as you remember, in the last bar in the daily chart, the daily momentum had become overbought, which was our setup to consider a short trade on the smaller time frame data. So let's take a look at where we're at as of the smaller time frame data. First of all, we take a look at the 60-minute momentum, and we can see that it's already bearish. So we've got the daily overbought, 60-minute bearish, dual time frame momentum set up for a short trade based just on the dual time frame momentum. Let's look at the timing. Is that as of the end of the day, February 27th, and the reason we're looking at the end of the day, February 27th, is because it wasn't until the end of the day on the daily data that daily momentum was overbought. So we have to be comparing apples with apples, so to speak, in the same time period. So as of the end of the day on February 27th, I've marked off just the ranges from the high to high, the significant high to highs over the last few weeks. And we see it's 26 bars, 30 bars, 32 bars. And as of the end of February 27th, the high on the 27th was 29 bars, right within that 26 to 32 bar range. So I've noted that in two places. This is our time band for a high based on the recent high to high cycles. I've counted over 26 bars, and I've counted over 32 bars from the last high, and we can see that high to high time band is between 15:30 in the afternoon on the 26th and 14:30 in the afternoon of the 27th, and that's the recent high on the 27th is right within those time counts, high to high. I'm also showing it on the indicator window, the time band, which is that little horizontal line, and shows the high to high time band also from the afternoon of the 26th to early afternoon of the 27th. So it's showing the same information two different ways. And just see how simple it is. I've just gone back on the last few, obvious highs that the market had, done some counts. I've seen that they're fairly well grouped. So if this market is going to continue this high to high time rhythm, more than likely February 27th is a high that's going to last for a day or two at least. That would be a comparable high to the last highs. So it's in a good position for this market to be at least sideways to down for another day or so. And when we consider that with the larger time frame, price and pattern and momentum position, we can see the smaller time frame is also indicating a high. Now there's a possible ABC I've labeled just like I did on the daily charts. Let's look at the alternate price projection, the 100% alternate price projection. Let me square the chart up there. There we go. And we can see that the high to date is just a little bit above that 100% alternate price projection. And that was also the 78.6% retracement. So we've got a retracement, an alternate price projection. What about external retracement? Well, we've got let me clean the chart up a bit here. We've got the 127% right near the 100% alternate price projection and the 162% a little above it. I'll clean the chart up, and what we know is right around the high on the 27th was a 78.6% retracement, 100% alternate price projection, 127% external retracement. So what a great position for a possible ABC high as of February 27th. So everything's in place to initiate a short position. Now we just need, what's the entry strategy that we're going to use? Well, let's use the swing entry strategy for this example. And let's say that you're a swing trader and you really don't have the time to be watching the market throughout the day. So one of the entry strategies, one of the two that you learned, is just to enter below a swing low. I got to take off the hot pivots. So the recent swing low, let's see if I can get the right bar there. Little swing low near the end of the day on the 27th is at 1374.75. So if we're not able to watch the market during the day, we could put in a 1374.50 sell stop to enter short. And where would our buy stop be? What did you learn? It's totally objective. There's no thinking. There's no considering, agonizing over where it should be. It should be one tick above the swing high made before the little swing low and entry. And the swing high, which is the high on the 27th, is 1390, so 1390.25. Now, that's a little over a 25-point stop On a futures trade, that's fairly large, depending on your account size and all. So if we didn't want to use the highly leveraged futures, we could use an ETF like the SPY. What's our objective here? If this is making an ABC, what's the minimum we would consider the market should do if this is an ABC high? Well, the minimum, as you learned in the book again, would be a decline below this possible 1 or A low, so below 1370.50. If this is a correction coming up, and we're correct in that assumption, and all the factors in place that indicate it could be a correction, then we should have another swing down to below the 1 or A low. Now, we don't know if that's going to be, wave C down or wave 3 down. It's irrelevant at this point. All we're looking at what's the minimum expectation. So that's about a 55 point plus possible reward against about a 25 point capital exposure. So a little over 2 to 1, and that's the minimum expectation. If that's just an ABC rally coming up, we may have a much further decline to go. So this is a great trade setup. Whether you're going to use futures or you're going to use an ETF, either one is a great trade setup for a short position. Now, what if you're able to watch the market during the day and look at even shorter time frame intraday data? Let's say you are a futures trader and you can watch the market during the day. We might go down to the 15-minute data for our entry strategy, our specific entry and stop, and have much less capital exposure if we're able to look at the market during the day. And let's go ahead and do that. Let's look at the 15-minute data. I did want to mention one thing before we look at this 15-minute data for our entry strategy and trade management, and that I misspoke on the earlier section that the capital exposure would only be about 15 points, not 25 points. Made the wrong calculation in my head as I was speaking. And with a probable decline to below 1317.50, that would be well over a 3 to 1 reward risk ratio with a maximum about 15 point initial capital exposure. Again, it doesn't make any difference on the trade. I just wanted to kind of clarify that. We could still use futures or we could use ETFs, either one for this potential short trade. Okay, now let's get on with the specific entry strategies and trade management. Now we're showing the 15-minute data. And again, it's the last bar in the 15-minute chart is as the end of the day on February 27th. In other words, we're showing the same data up through the same time period as both the 60-minute and the daily data that we've already looked at. Well, let's take a look at the position of the last bar. We could just ignore the time or price or any of that kind of position on the 15-minute data and just look at the 15-minute data for our entry strategy, like on the swing high or low. But let's just take a little bit of look, see if we can get a little bit more information. On the 15-minute, we also have the momentum bearish, and it looks like just 1 or 2 bars off the overbought zone. So it must have just turned bearish near the end of the pit session data. And again, I should have mentioned before, I'm only looking at pit session data, not the 24-hour overnight data. For a market like the S&P, all the volumes during the trading day session, what we call the pit session data of the futures. So we only look at that. So we have the 15-minute momentum has just turned bearish near the end of the day. So there should be at least several bars on the 15-minute sideways to down before the 15-minute momentum reaches the oversold zone. So it's an immediate position to consider a short trade. We'd only not consider the short trade if the 15-minute momentum was already oversold, because then the downside should be very limited. I've marked off the recent obvious highs on this data. And look at how tight these are. 15 days, 17, or excuse me, 15 bars, 15-minute bars, 17 bars, 19, 17, 18, and as of the last little swing high near the end of the day on the 27th, it was 18 bars. So we don't need to do any sort of fancy timing here to recognize that this last little swing high near the end of the day was right within a very narrow time range to complete a comparable high to these other highs, which is another indication that the S&P is likely to be sideways to down for several more bars. So we have momentum and we have price, also on the 15-minute data, indicating that this market is going to continue lower. So we have really three time frames here. Daily data is set up for short, possible ABC high. 60-minute data is set up for short, both on momentum, timing, price, everything. And then the 15-minute data as well. So we've really got a great triple time frame set up for a short trade. So what would our entry strategy be if we want to do the entry off the 15-minute data? Pretty simple. We just draw a line across the last little swing low, square up the chart here a bit. Actually, I'm going to put fewer bars on so we can see it even better, and I'll make that thick. This is our swing entry strategy, swing breakout entry strategy that you learned in the book. Entry at a tick below the swing low, in this case 1374.50. Where would our stop be? Does our stop need to be all the way back up here over this high, the high of the 27th? Well, if we're just looking at 60-minute data, yeah, it would need to be back there. Give us fairly wide stop. We'd probably choose to use an ETF instead of futures data. But on the futures data and the shorter term data, 15-minute, the last swing high was this little one near the end of the day, which is at 1384.25. So if the market declined and took us into a short trade, on our sell stop below the last swing low, our stop is going to be a tick above the swing high made prior to entry. And that would be 1384.25, so stop would be at 1384.50 for about a 10-point initial capital exposure. Several points less than if we used the swing high going back a ways. Well, now we've got a good setup, and particularly considering we had about a 50-point minimum expectation for a decline if this market is making this wave C high. And of course, notice that I have it with a question mark. We don't know if it's a wave C high or not, if we've completed an ABC correction or not, but we do know that it's in a position to do so. So, and remember what our minimum expectation is. I'm going to go back to the 60-minute data. It's below 1370.50. So if that's our minimum expectation, 1317.50, it's 55 points plus, and here we'd have a 10-point capital exposure. Boy, that's a great risk reward. We don't need any fancy programs to figure out that's a pretty good deal. So we want to be short if the market takes out this swing low. So let's add some bars and see what happened. Up to now, we've just taken a look at the position of the market as of the end of the day, the 27th. We've found that a high probability of the market making an ABC rally into February 27th. We know all the conditions are in place, at least for it to be a wave C high. Now we have our specific entry strategy, specific initial stop. Let's see what happens as we add a few bars. Well, there's the first bar, first 15-minute bar of February 28th. And it gap opened again. When I say gap open, that means this is the pit session data. Gap opened below the swing low. So if we had our sell stop in, we would be shorting that trade from the open at 1370.50, within a tick or two. So we'd be short with a stop 1384.50. So our entry was a bit below the swing low because of it's really not a gap opening with the 24-hour market, but using pit session data, and our stop is above the minor swing high. We've got a short trade with anticipating a decline below 1317. So let's take a look at what our exit strategy is going to be. So how would we manage this short trade? We've identified all the conditions that give the February 27th high as in a position to be the end of an ABC correction. That would assume that we would anticipate that the market would decline down to a new low, well below the low that's shown on the chart, the 1327 low. We're short from the open of the pit session around 1370.50, and with a stop about 1384.50, not about, but at that, a tick above the minor swing high. So I'm going to go back to the 60-minute data for our trade management of this, even though we went down to the 15-minute data for our trade entry. And as it so happened to have worked out, is we wouldn't have had to follow this market during the day for the shorter term intraday data, just given that the market gapped down on the open there below that swing low. Now, for those of you who might be looking at 24-hour data, you might have actually got a better fill if you had a sell stop in, but generally I don't look at the overnight data, the non-pit hours data. I'd rather be looking at the data that has the highest volume, gives us the best results in our time and price and targets in our pattern, that sort of thing. So we're short this trade. Let's go back to the 60-minute data and see how we'd manage the trade, because we want to have our trade management plan in place now. So now we have the 60-minute data, and I've cleaned the chart up a little bit. I've got the first 60-minute bar on the chart for the February 28th. I'm just going to take those swings off. I want to get the chart as clean as we can. So what's our first objective as far as trade management? Well, remember in the book you learned that we always trade with at least 2 units, and we look at 1 unit as a relatively short-term trade. And the basic philosophy is that what if we're completely wrong about this February 27th being a wave C corrective high and the market continuing down to a new low, and any decline is just a minor correction? Well, a minor correction to the last swing up, which I've got labeled as this minor wave B low. I'm just going to mark it off so we can refer to it a little easier. So if this were just a correction coming down from the high, we would expect it to come down to around the 50% to 62% retracement area before continuing higher. So we're going to look to exit around the 50% or so area if the market reaches that area. Again, it would, if we exit around there, it'd just be a very short, relatively small profit on the short position, 1 unit of this short position. But like we had in so many the examples in the book, we always have to assume that we're not correct, that our analysis is not correct, that the market is not going to make a big move down, that maybe it's only going to make just a relatively short-term correction. So we take profits on 1 unit, then we keep the stop relatively wide in the second unit in the event that the market does what we anticipate it doing. So the stop strategy on the 1 unit, the short-term unit, will be if the S&P either reaches 1358.50, which is the 50% retracement, or following a 60-minute momentum bullish reversal, and will trail the stop 1 tick above the 1 bar high on the 60-minute data. We're not going to touch the stop on the second unit just yet. We're going to wait till other conditions have been met. But for right now, either a bullish reversal following a bullish reversal on the 60-minute data, momentum, are reaching 1350, 850. If either of those conditions are met, we're going to trail the stop one tick above the 60-minute one-bar high. So let's add some data. And I guess first I should say that's the logical stop strategy that you learned in the book. We're either looking for some condition to be met that a short-term low may be made before we bring the stop close to the market on the short-term unit. So okay, now let's add some bars. We're adding 60-minute bars one at a time, and we'll see if either of our two conditions are met. There, as of the last bar, we see 60-minute bar is the 60-minute momentum has made a bullish reversal. So we begin to trail the stop one tick above the one-bar high, even though we're just, it looks like probably only a point or two below our entry price. Maybe this market isn't going to go down, we don't know, but with a 60-minute bullish reversal in the momentum, there's a reasonable possibility that it's going to be up for several 60-minute bars. So there wouldn't be any reason to remain in at least the short-term unit. We haven't even reached the 50% retracement yet. So we're going to trail the stop one tick above the 60-minute one-bar high. Let's add some more bars on here. There we go. We had one more bar left in this day. This is the opening 60-minute bar of the next day, which is another big gap down, a big decline, and below the 50 to 62% minor retracement zone. So we just continue with our strategy. There's no reason to change our strategy. We still have the 60-minute momentum is bullish from the oversold zone. So we should be near a time where this market reaches at least a temporary low and maybe has a temporary corrective rally. Let's add some more bars. And one thing that we can do is I'm going to put an alert on here on the one-bar high. One-bar high, and that way, as we add new bars, we'll just have an alert. And that's most software programs, like my Dynamic Trader program, gives you the ability to put alerts in under certain conditions. And there we go, the alert just got hit. So we were stopped out, and of course in each 60-minute bar we would adjust the protected buy stop on one unit. We're stopped out at 1345.75, and that was on the short at 1370.50. So 1370.50 from 1345.75. That's a 25-point gain on the short-term unit. Now we haven't adjusted the stop yet on the longer-term unit. It's still way back here at 1384.25. And I know logically, if we had a big gap down like this, we would move it probably to break even, at least break even. But I'm going to keep just with a very logical, straightforward, step-by-step plan and not make any after-the-fact sort of decisions. So we're stopped out of the one unit with about a 25-point gain. Let's see what our strategy, trade management strategy would be to the second longer-term unit. So how do you think we'd manage the stop on the second unit? What would be a logical way, given our two primary time frames of the daily and the 60-minute data? Well, we are anticipating that the market's going to decline below this February 7th low. That was what we had labeled on the daily chart as the 1 or A low, but maybe or maybe not it's going to do that. What would be conditions that would indicate the market is making a low that might last several days? Well, one of the conditions is if the daily momentum reached the oversold zone. I mean, the downside would be limited, and certainly once it made a bullish reversal, this is the daily data, is that the downside should be quite limited, and we'd want to bring our stop and trail it very close to the market. The other might be if the market reached the 100% alternate price projection on the daily data. And let's take a look at where that would be. Actually, we can do that on the 60-minute data. Let me just pull up more data. The 100% alternate price projection, this first decline, projected from this high. Let's work that in. It's just below that February 7th low. Oh, I wanted to make it thick, and it was already thick. Would be around 1310. So if we either had the daily momentum make a bullish reversal, or if this market reached 1310, we would want to trail that stop very close to the market. Okay, let me go back and get fewer bars on here so we can see it. Let me clean up the chart quickly. I'm going to take off that exit price. We can see that it's just tagged at 78.6% retracement. And we'll clean all of these bars up that we don't need. Clean those off. And I'm just going to put back right near that open is where we entered the short position. Alrighty, so as of the last bar in this chart, where we just got stopped out of the short-term unit, is there a logical place for us to adjust the stop on the intermediate term or longer term unit that we have for this trade? Well, how about this swing high? Is there any reason to have a stop further away from this little minor swing high? Well, I don't think so. This is just sort of logical market structure that if the market were to rally, which would be almost 30 points, and take out a swing high, more than likely this decline is not going to continue. So we can adjust our stop to 1374, well 1375, a tick above this swing high, which still has about 5 points capital exposure on the intermediate term unit, but we just don't want to bring that stop too close yet. We already have a 25-point gain in the short-term unit. We don't want to be adjusting this stop before this market really gets underway going down, if it's going to. But right now we can decide how to adjust the stop in the intermediate term unit. And think, what's a logical condition to which we want to adjust the stop? We already know we're going to adjust if the market comes down to 1310, the 100% alternate price projection, or the daily momentum makes a bullish reversal. But before then, how might we adjust it? Well, if we're using dual time frame momentum to enter the position, we might use it also to adjust the stop. So the next time the 60-minute momentum makes a bearish reversal from above the oversold zone, we can adjust it to the swing high on the price data that was made just before that bearish reversal. So let's add some bars and see what happens. That's a specific strategy that we have that's going to bring, or well, it'll bring the stop lower if the market continues lower and makes another bearish reversal in the momentum. And it's a very logical way. It's one of the ways we showed in many of the trades in the book. So let's go ahead and add some data. We're into the following day now. Now we're, as of the last bar in this chart, well, we didn't get much of a correction at all, just went sideways, but we have had the 60-minute data, 60-minute momentum come up and make a bearish reversal as of this last bar. Well, where's the high prior to the last bar? Well, it's right in this kind of sideways little trading range that we had. So our stop now would be all the way down, big adjustment, to a tick above the swing high at 1335.50, so about 1335.75. And that locks in a very strong gain on the second unit from our entry at 1370.50. That's about a 35-point gain that we've locked in now, and in a very logical way. So we've also, this market is just, as of the last bar in the chart, looks like it's about just a tick or two away from the 100% alternate price projection. Let's look and see where the daily momentum is as of the last full day, and that would be March 3rd. And by the way, I'm not sure I've mentioned this before, that when these bars change colors between the kind of gold color and the blue, those just represent different trading days. So visually, you can see different trading days on the chart. So here we have the daily data, and I think we have it as of March 3rd, the last complete trading day. And we can see that only the fast line of this momentum indicator is in the oversold zone. So both lines aren't in the oversold zone, so we don't consider it oversold, and certainly hasn't made a bullish reversal. So if we just were considering momentum, we would consider that there's probably another 2 or 3 days of this market to be sideways to down before it makes a daily momentum bullish reversal. And we want to be exiting as near to that daily momentum bullish reversal, because it typically means that the downside is very limited and the market's going to be sideways to up for several days. So let's go back to that 60-minute data. We're back to the 60-minute data. We've got a couple bars into this March 4th. We've got the bearish reversal, and we're a couple ticks above the 100% alternate price projection. So we've adjusted our stop. If we tag this 100% alternate price projection, let's trail the stop 1 tick above the 60-minute 1-bar high. Okay, again, very logical. Even though the daily momentum isn't all the way oversold, as the market is down for this day, more than likely it's at least going to be reach the oversold zone, both lines. So I'm going to add some more bars. And it looks like as of this bar, we're going to trail our stop 1 tick above the 60-minute 1-bar high. We've hit the 100% alternate price projection. So let's put that alert in. Now, as of the last bar in the chart, the high is 13.19, so we'd have our adjuster stop at 13.19.25. Now let's go ahead and add some bars. There we go. We would have been stopped out a couple bars later at 13.16.75 plus a tick at 13.17. So we'll take that out. Short from 13.70.50 on the second unit, and stopped out at 13.17 on the second unit for more than a what's that, a 50, we'll calculate this in a bit, but over a 50 point profit on the second unit. And each step of the way, each decision made was very logical, based on all the strategies you learned in the book. And again, not particularly complicated. As we make decisions logically, sometimes the market makes strong moves in our direction, sometimes it doesn't. Now I want to go back and mention one thing before we kind of do a review of this trade. I'm back on the daily data. I'll add, this is the day that we got stopped out. This last bar on the chart, what is it, March 4th. The momentum as of the end of that day was in the oversold zone, so typically that means we're a day or two away from what we call a daily low, one that would last for several days. But if this is making bigger A, B, C, let me just put some labels on here. And clean the chart up a little bit. There we go. If this is a 1 or A, 2 or B, well, if this is an A and that's a B, we're right in a position to make the wave C low. If this is just a 1 or a 2, we would have much further down to go. And at this point, with this data, do we know whether this is a bear trend coming down from early February or just making an ABC correction? Well, we don't know. We don't know if it's making a wave 3 or a C in Elliott wave terms, whether it's a trend or a counter trend. Now, if we had more data, like looking at the weekly data and weekly momentum, we might be able to make that decision if we would want to consider a longer term short position. But with the data we looked at, We're out as of the day, the last day on this chart, and everything looks copacetic. We were in under the right conditions. We got out in the right conditions. We don't know if the market's going to continue lower or not, but more than likely, based on the higher time frame daily data, the downside is fairly limited. So it ended up being a very good trade. Though we went down to the 15-minute data for our entry, we were adjusting stops on the 60-minute data. Let's do a quick review of this trade. As of February 27th, the high on February 27th was in a position to have completed an ABC corrective high. We went through the daily and the 60-minute data, the time bands, the price position, the pattern position, the dual time frame momentum position, and all indicated that it was in a position to be a corrective ABC high. We don't know if that's the case, that's what it was going to be or not, but the conditions were in place for that. So it was a great setup for a short trade. We went from daily to 60-minute to 15-minute data for an entry. And if we were just using the pit session data, we would have entered on this gap below this little swing low around 1370.50. Our initial stop was right above the minor swing high, 1384.25. We looked to take profits or exit on the short-term unit if the market either reached the 50% retracement or made a 60-minute momentum bullish reversal. And once it made the 60-minute momentum bullish reversal, we trailed the stop in the short-term unit one tick above the 60-minute one-bar high, and we're taken out around 1345.75. We continued to hold the second unit in the event that the market continued to decline as anticipated. The market did do that. Our strategy was then to adjust the stop on the intermediate or longer term unit once the next 60-minute momentum bearish reversal was made. And when it was made, we adjusted the stop to right around this swing high, locking in a 25, almost a 35 point profit on the intermediate term unit. Market continued lower, and our strategy that we had made up in advance was that if the market reached the 100% alternate price projection or the daily momentum made a bullish reversal, then we would trail the stop one tick above the 60-minute one-bar high. And it reached the 100% alternate price projection before the daily made a bullish reversal. We trailed our stop, and we're stopped out at 1317. So each decision was made very logically in accordance from the simple strategies you learned in the book. And as the market progressed, we had a very logical way of thinking of how to adjust the stop, where we'd want to begin to trail that stop very close to the market because the downside would probably be limited. So go back and look through this example again, and you'll see again how each decision was made as the market progressed and given the information that the market provided us.